Hello fellow trade geniuses, this is Philip, and in this video we're going to talk about trade expectancy. What is trade expectancy? Well, simply put, it's a way to tell you whether or not you have a profitable strategy, and it follows a simple formula. The formula is expectancy equals probability of a win times your average win in dollars minus the probability of a loss times the average loss in dollars. So this is your trade strategy probability of a win versus trade strategy probability of a loss with the accompanied average winnings or average losings. So if you're just looking at this as a formula and you're not a fan of formulas or math, that might look like might make you cross-eyed. But I'm going to apply it to our binary option signal. Okay, so if we take the formula probability of a win with our intraday FX high probability signal, then we take the 96% of our average earnings of $18 a contract, and so during the day we'll call out, get such and such a trade at 15 or better, or 20 or better. It usually works out to be about an $18 capture over the long run. So our average win rate is 96%, our average capture is $18. So 96% of $18 is $17.28. Now on the other side, we average at 4% losers out of the signal, and when they lose, because we're in the money, they're going to lose more. So average loss is $82 a contract, but only 4% of the time. So 4% of $82 equals $3.28. So you take the $17.28 minus the $3.28, and your expectancy is $14 per contract per trade. So when you look at taking a signal, or you look at entering a trade with a strategy, it's not really what the win rate's going to be, or is if that trade's going to win. We don't know if it's going to win. We expect it to win. That's why we enter the trades. We also expect that once in a great while we're going to take a loss, but we don't know what's going to happen after we enter that order. But what we do know is that we are expecting to average $14 per contract per trade over time. And that really helps you mentally, knowing that's what statistically that trade will make over time. That's its expectancy, $14 per contract per trade. Okay, now what about, let's try the FX swing signal. So this one's a little different statistically. They have a little bit of a lower win rate, but a higher capture. So average on swings is 83% times $45 capture. So 83% of 45 is $37.35. 17% of the time we lose, and when we lose $55 premium. But since it's only 17% of the time, 17% of $55 is $9.35. So when we get into a swing trade, 37.35 minus 9.35 means that we should expect $28 per contract per trade as the expectancy when we enter into that swing trade. So when we think of it in terms of expectancy, it really helps us not worry about it whether it's a winner or a loser. We know, because of logging and the statistics, that has a positive expectancy. We don't know if it's going to win that time. We don't know if it's going to lose that time when we enter that trade, but it really doesn't matter. What matters is keeping track of what the expectancy rate is of that trade. Now, do you need a positive win rate for positive expectancy? And the answer is no. So, for example, you could lose 70% of the time, but when you lose, you only lose $10 per binary contract. So if you take 70% of $10, that's $7, right? But then on the winning side, if you take 30% winners, but you're capturing $90 in premium, so that works out to $27. 30% of 90 is $27. And so 27 minus 7, you're making $20 expectancy per contract per trade on a setup that only wins 30% of the time. So as you can see, the win rate percentage wise, although most people refer to that, and most people, it makes sense to them to refer to a strategy by its win rate, really doesn't mean much unless the average win is better than the average loss. Okay, and that's the important point to know. So when you're tracking your performance, if you follow this formula based on your winners and your losers, and you should be logging this, and we'll get into that in another video about logging, then you're going to be able to tell yourself whether or not you're performing well and the trades that you're entering are giving you a positive expectancy. Because without a positive expectancy, no matter what the win rate is or the losing rate is on a trade setup, if you do not have positive expectancy, or you cannot self-perform positive expectancy on a particular strategy or signal, then you need to stop and you need to reassess that signal or that strategy or your own performance and figure out what's not working. So I hope that helps. It's a subject that's out there, but not a lot of people grasp it, and they get focused on a win rate or loss rate. And really what it comes down to is having a positive expectancy. So this formula will answer that question for you. So I hope this helps. Thanks for watching. Subscribe to the channel. Leave us a comment below if you have any questions. Or if you'd like, visit our website, sign up, and get into the room where you can ask questions all day. And we not only cover binary options, but also stock signals as well. So until next video, take care, guys, and happy trading.